XAnalysts. Empowering analysts, transforming markets.
Hello, everyone. Welcome to another episode of Exploring the Energy Market podcast series, where I plan to bring, and I've been bringing guest experts across the globe who know the depth of the region, who know the geography, who know the technical details around the oil market, the energy market questions. Today, I have a guest from the Middle East, Iman Nasseri. So, welcome, Iman. Welcome to the podcast. And we are going to talk a lot about the hot topic, what's happening in the Middle East, and you are in the epicenter of what's going around. Today, I don't want to go into the geopolitics. There is so much of speculation, opinionation going around, but really, you have a long history as an analyst, as a person looking at the region. I want to touch upon what has changed, what has not changed. How do you see the pathways and scenarios ahead? And at the end of the day, I think the goal is that the listeners, the viewers walk away with a better informed perspective so they can build their own views, they can build on their bias. So welcome, Iman. But before I go there, I want to talk about your analyst journey. So tell me a little bit about your analyst journey and what really excites you and how you have grown in the region.
Yeah, thank you, Mukesh, for inviting me to your show. My analyst journey started about 20 years ago, in 2006, when I joined Iranian Oil Ministry's Economic and Market Research arm, a think tank in Tehran, where studies are done for the Ministry of Oil to highlight market movements. Back then, I was an engineer with a graduate degree in energy systems engineering, very little knowledge about economics and market. In about 2 years into that journey, I realized that while I do have a good understanding of how things are done from an engineering point of view, I do not appreciate the economics behind things and certainly how markets work. So I decided to start the journey to do a PhD in economics with a focus on energy economics. And in fact, when I started my PhD in Hawaii at the University of Hawaii on economics of renewable energy and how it impacts an economy relying heavily on fossil fuels, which in that case study for my PhD funded by UH was on the state of Hawaii, about 90% powered by crude oil imported from Indonesia and Malaysia, Tapis and Minas, the two most expensive crude in its own time, heavy sweet crudes, refined to produce almost entirely very low sulfur fuel oil or low sulfur waxy resid equivalent to light up the shores of Honolulu, wherever all the tourists would go and see, in fact, the gas burning at the torches are reformed naphtha into natural gas. So all of that was an interesting journey into how markets react. From there, I met my first boss at FGE, the founder and chairman and CEO of FGE, Dr. Feridun Fisharaki, who encouraged me to join the world of consulting and market analysis. While doing PhD, I joined FGE in 2009, and ever since I have come across the energy commodities markets. I started with LNG a few years, as State of Hawaii was and still is, interestingly, over 2-3 decades, looking into moving away from fuel oil into natural gas and has not succeeded yet. And then I moved to London, working especially and studying the NGLs market. Ethane became an interesting commodity with US shale encouraging ethane trade started with INEOS and then Reliance and then China, and LPG landed in as the managing director for Middle East research at FGE. 10 years ago, 5 years ago, moved to Dubai to watch the market more closely from where things happen. I've been here since 2021 and recently expanded my area of coverage from Middle East to east of Suez, covering Asia and the Middle East, and working closely with my colleagues in Singapore and Dubai. That's the journey I've been
Well,
on.
first, fascinating, Iman. And first of all, indeed, congratulations on taking a bigger remit and elevation. I think long years. And I was smiling when you were mentioning. I also started as an engineer running plants, and I always wondered why what happens. So economics, the curiosity of economics, is also the same bug, I guess. Took me into oil markets, energy markets analysis. But so that's really fascinating to really, understand your journey. And you also mentioned that you went to Dubai to watch the markets. Well, you are in the market where the action is on. So let's start, Iman, with I think the question which probably is on everybody's mind. Describe to us what do you really seeing on the ground, what's happening, but more important, I think provide a little bit of a context to the viewers on this just didn't happen now. I believe it was in the making for the last 1 to 2 years or so, and maybe more. So give a little bit of a historical context on why what is happening now is happening, and then we will dive deeper into how the future would look like.
Sure. Mukesh, one of the first lessons I learned when I started graduate program in economics was Invisible Hands of Adam Smith. I have his book still on my shelf, which he says that the markets solve always every problem of supply, demand, and balance it through price. We have learned it a few times over and over again, especially in my 20-year journey. I've seen a few what was before it happened and expected to be a really significant development in the market. It happened, markets reacted, invisible hands worked, and then we went through that journey. I remember 10 years ago when IMO announced the plan to move to in 2020, and in fact it was supposed to be earlier, and then finally happened in 2020, IMO 2020, from HSFO to VLSFO. It was a big news. It was shaking the market that how can we basically 3, 4, 5 million barrels per day of bunker market. It did come and go. The markets adjusted. When Russia-Ukraine happened, many people didn't think about how the markets react and adjust to significant amount of natural gas and diesel, for that matter, that was coming from Russia to Europe. It did come and go, and the market reacted. Now, I was just telling a head of a trading company that I had breakfast this morning, that if you'd asked me in January 2026 that the Strait of Hormuz will be closed at some point and will remain almost entirely closed for 5 months, and the price is $79 after 5 months, I would tell you that you're insane. You either don't know how the markets work, or you don't know how much oil goes through a Strait of Hormuz and all of that. Now we are there. So what is very important lesson is that, yes, it was a significant development that has happened in this region over the past 5 months. It has significant geopolitical and political implications. It has distorted markets significantly, and it has impacted several economies in significant way. But the markets have proven to be more resilient than breaking, and prices have certainly solved some of that. But also the engineers who don't know how things happen, but they know how to make things work, have enabled the market to adjust and adapt. Now, we're far from a solution to what happened. We're far from a new status quo or a new paradigm, but the market has certainly lost some of its fear, and that's partly behind the current pricing that we're expecting now, and has gained more confidence that yes, working together could potentially solve big problems before or problems that we think they won't be solved by any means or tools before they happen.
Now, I think fascinating that you mentioned the invisible hand, and I'm kind of just thinking, yeah, the invisible hand of the engineers, right, who go around and we have now a lot of damaged refineries, we have a lot of damaged upstream assets, we have a lot of damaged ports. So I think there's a lot of engineering work to be done to bring back life, but the market has really sort of been more resilient. Why do you think that the market has been more resilient? What would be 1, 2, 3 top factors in your mind that the disruption of this order, which everybody feared, but market, we knew beforehand that there is a East-West pipeline. We knew beforehand that UAE has other alternatives, but why it didn't break the market? Like you were mentioning in January, if somebody would ask you, and what is unique about the Middle East, which others don't understand, that has kept Middle East flowing and resilient?
Every problem finds its solutions fitting its nature. And the nature of this specific problem that the market has been facing was more geopolitical tension than a sustained physical loss. I believe the war has caused damage to downstream assets, as you mentioned. We have had both on the refining, but also gas and LNG and GTL facilities. We have had some damage to upstream, but significant amount of physical supply loss hasn't happened. And when it comes to geopolitical tension, then one thing that has driven markets also over the past 5 months has been basically the headlines and the messaging, the sentiment, which is heavily impacted by hopes, by words. And we have some people definitely who are experts in creating noise and basically adjusting messaging on both sides, perhaps, of this conflict that we have been witnessing. We have had a strong messaging that has tried to impact the market. And as I said, the key underlying factor that has caused the market not to go mayhem, the market not to go into the uncharted territories, although I have to correct myself and say prices did go above $200, especially if you look at the product prices where the consumers are paying. And we are still seeing prices in excess of $140 when it comes to middle distillates. But crude prices, what people focus on, and that's mainly because everyone was looking at the upstream asset and supply and say, okay, these are intact, there are solutions. And then obviously inventories, obviously some spare capacity, and rerouting. As you said, people were talking about it. We did an alert on East-West pipeline and its capacity. No one had tested them in terms of how fast and how effective they can be, but they all proven to be working. China proved to be a big part of the equation there. They certainly both were actual part of a physical solution, but also messaging. They did also calm the market in Asia through some of the decisions they made, which didn't immediately translate into physical impact on fundamentals, but they did send message to the market and help with the sentiment. And obviously the demand response, which was the part of the market mechanism. So all of these, I believe, were the reason that a market which was resource constrained but didn't lose its physical supply managed to be where it is today.
I think that kind of connects the dots, that it's not the real, there's more hot talk than the real hard damage to the upstream assets. Damage to, I guess, the logistic systems are there, but logistic systems are can be repaired faster than the underlying, assets, and probably those damages are also overblown by a lot of people around to cause scare and panic, and then there is volatility, and then there is trading as well. So I think fundamentally that's what you're talking. But in terms of going forward, how do you see what has not changed in the Middle East? I believe these countries were part of a big bloc called OPEC, and they were doing quite a good calibration job of the market. And despite huge geopolitics since the Ukraine war, despite we had about 60 elections in over 2 years, huge geopolitics, but the OPEC was able to create good price stability despite all of that. So what has not changed in the Middle East despite this crisis? What would you put 1, 2, and 3 as the top things in your mind?
I believe what was interesting observation, and what hasn't changed is that in the context of OPEC, as you mentioned, what OPEC delivered, and because the key drivers in the OPEC were from the Middle East, somehow you could say that Middle East, as part of OPEC, has shown cohesion and integrity. This integrity and cohesion was also demonstrated over the past 5 months in terms of reacting to what was happening between one of the Middle Eastern countries, Iran, and other countries, US and Israel being part of this, is the way the Middle Eastern states and economies reacted. They did not contribute to the escalation. They did react in a way that they tried to be part of the escalation, calming, and basically being more of a democratic path to end this rather than becoming part of this. This integration and cohesion, which was certainly also part of this, as I mentioned, headlines, messages, and all of that was also coming from the Middle East. I believe that was a continuation of OPEC. When OPEC Plus was challenged a few times, when there was noise from the likes of UAE saying that they are unhappy, or Iraq has always been under budget constraint, the cohesion of OPEC proved to be more focusing on the best interest of the market in terms of stability, and for the producers in terms of staying together to make sure that the market is one that benefits the producers as well. So that has continued. I believe that was part of it. They haven't had enough time to let's say, work together on infrastructure, but certainly there have been discussions about them showing once again that logistics can be integrated, talking about pipelines going from one country to another. We have had the natural gas example that extends from Doha to UAE, Abu Dhabi, and Fujairah, and goes into Oman during the time of Qatar embargo. It did flow, so that still continues to be the case, that the region remains cohesive. That, I think, has been part of it. And then obviously spare capacity, inventories, Atlantic basin, and all the other mechanisms in the market didn't change. They all came to force immediately, the IEA response and all of that. So I believe, as I said, we faced a problem that on day one, it looked like a 25%, 20 million barrels per day of oil and 25% of LNG. It looked too big to be solved. But then again, what didn't change, which is all that in integrity and market mechanisms and fast rather response to this proved to be the cure and kept the market in check, at least to a greatest extent.
I think that's an excellent point, and now you made me think, which is I was not appreciating, was that imagine there was no OPEC before the war, and there was no history of OPEC. Every country was kind of working in their own self-interest, and the war breaks out, right? Then there could be much more confusion and I would say disruption. But OPEC had the history to manage the differences, manage some of the challenges among the members. So I think that history of cohesion is what you are highlighting, kept sort of beyond the headlines, kept the things from de-escalating, and has proved probably one of the biggest strengths of the Middle East, despite the headlines may look like that everybody is kind of fighting each other. But the presence of OPEC has played a part. Fast forward to today. Fast forward to today, Iman. Oman and Iran are now trying to, create two Hormuzes, one lane for myself and the other lane for going out inbound. What's your take? Is that something OPEC and these countries would agree? Yesterday, the market reacted with some price correction, and today everybody said, no, this won't work. What's your take on this headline? And is there an OPEC angle in it?
So to your latter question, no, I don't think so. And to the original question, I believe we have to separate the headline, the development between Iran and Oman, and what that means from Strait of Hormuz reopening and flows. I do believe that this whole effort by Iran is to keep Oman basically involved in what they claim to be the new paradigm and the new Strait of Hormuz management. They do want to be on top of it as part of their initiative after war, which I believe has now gained a lot more importance in their strategic planning on the Iran side than the nuclear development itself. And so this is basically saying that we want Oman to be part of this. However, if you read between the lines, what they are setting is basically just a new, let's say, legal and potentially financial framework to create some sort of authority for this passage. Whether it's international law accepted or not, that's a separate matter we don't want to discuss. But it doesn't mean that if it's all signed and agreed, even if all the other GCC countries are on board, it doesn't mean that from tomorrow the traffic is open to go, for example, inbound from Iran lane and outbound from Oman. There are two significant developments that are yet to be resolved, and that's perhaps what the market is also reacting. One is that, okay, let's agree that everyone says whatever you want to charge, be it $1 to $2 that some people think it may be fair, or $5 to $7 that no one thinks is doable. If that's solved, who is going to charge? How is it going to be paid, especially to a country and a state and most of their government bodies, including almost all IRGC-linked entities that are under sanctions. So the payment remains a problem, but Iran hasn't said, or I do think is not ready to reopen the strait to normal flows, even at the maximum capacity that could be below the pre-war routes. So I think they just want to show that, hey, the system is going to change. Let's work out a new system, but we'll keep it for now on the side as long as we want to keep the strait closed, and that's basically our privilege and our chip for negotiation with the state to get what we want out of this political conflict.
Another excellent, I would say, the way you said it, and I think this clearly tells Iman the deep understanding of the region and not just the oil fundamentals. I think what you're highlighting here is that even if the agreement is fragile, even if the agreement has multiple, loopholes and things which may not work out, but this tells that Iran, by working with Oman, is indicating that let's solve this problem. I didn't create the problem. The Hormuz was open before the war. An outside force came in and disrupted the things. You all were party to that thing and kind of maybe enabled. But now let's work together. And if you can work, Oman and Iran can work together. Maybe others can also work together. And that's how the region solves the problems themselves without the outside interference of other parties, because there is huge stakes involved for everybody in the region. So it's kind of a demonstration of that, even if probably they know that this is hard to work, but this also kind of might create the pathway for something which the entire Gulf countries could kind of come together. So do you see from that point of view, if I'm summarizing it well, any scenarios ahead? One, yes, the Gulf countries would come together, or the Gulf countries would be very unlikely to come together given Iran has attacked them. What's the scenarios in your mind?
Uh, yeah. So when you ask me about scenarios, I would like to again keep these two separate. Scenarios regarding the Strait of Hormuz and how it's going to be managed and controlled and all of that. Uh, I think they may be willing to work together and create a legal framework to formalize the control and ownership of rights over the use of this passage for international trade. Whether everyone agrees to a fee going to one country or to a fund that could finance separating, those are all, in my opinion, solvable. And I believe as members of the same society, same community, being the Persian Gulf region, and from where we started, the cohesion and integrity that they have shown, even with Iran as part of OPEC in that platform and environment, I believe that's doable. Whether the current proposal that we have all heard and read about it over the past couple of days is one or it has to change, I think there may be a solution to that. However, as I said, scenarios forward for whether this mechanism is doable and is going to be utilized tomorrow or the day after everyone agrees, I see three scenarios in front of us, Mukesh. One that is more likely, and the reason I say more likely is that the other two scenarios that I'm going to tell you are hard to either define very well in terms of how they happen, but also put a time, attach a time to them. The more likely scenario, as you and I have studied in econometrics, when you're looking at a random variable, the best forecast is repeating the future. So tomorrow is the
Mean
same
reversion,
as today, right? Yeah. So we don't know when and how things happen. So the status quo, staying in this current state of half open or partially open, mostly closed for some time, is the best forecast to assume if you want to think how it evolves. Because to get out of this, we have two ways. A way through diplomacy, which is a deal between Iran and the US to begin with, but that deal has to be endorsed and somehow other parties, which first on the US side bring Israel into the equation, and then from the people being impacted or having been impacted, the GCC should also be on board. That deal seems to be a very hard one to imagine. Would that please everyone, especially given extreme opinions and interest of Iran when it comes to all of this, as well as US Israel. I would give a very little chance to that pathways. And I was telling the same thing in early June, then suddenly MOU came. It surprised everyone and
Mm-hmm.
myself. But I kept saying that this is a very, very fragile. This does not look, and it proved to be short-lived. So a real solution is hard to achieve. The other way out of the business as usual stagnation is another military conflict, a conflict which is, I would call it political conflict in Iran, either through another war coming back, which in terms of timing, I would say that most likely after midterm election, probably December, January, February than before, or another political development within Iran that brings Iranian regime and the administration into a different pathway, a different wish list that could potentially bring us back to that low chance resolution. So, be it a coup d'etat, be it a change through leadership, one way or the other. So, we are seeing the two pathway out of
Mm.
this. Uh, those that we cannot really define because it's hard to define it now, given the current situation, but also timeline. We don't know. It could be tomorrow, but it will be a surprise. And when we don't know it, and when we expect a surprise, the best thing is that tomorrow is the same as today.
I like that. And I think the way you've painted the scenarios, one, where the actors, the IRGC, the US, and the players retain their current power positions. And what you're saying is that there is no like magic formula. It will be off and on and off and on, a slow grind to a solution. So there is no magic wand coming and solving overnight and be back to. The second scenario, what you're pointing out, is that either there is a change, something in the US power metrics, or there is a change in the Iranian power metrics, or maybe in the region power metrics that might bring a totally different scenario. And the third is where there is another outright war when US retains its power, the US administration wins the midterms, Iran retains its power, and then they again, after a break, fight it out again. Out of all these, given those are harder to predict, what you're saying is, for now, talking peace, Iran, Oman, putting proposals, at least keeps the region away from missiles and attacks. That buys time to people to find common ground, but it will take quite some time to solve this problem. So we should expect the Hormuz not to open partial on and off leakages and things to somehow find its ways till engineers find a better solution of it. And that's how you see the next few months going forward. Did I good job in the summary, Iman?
Yes, absolutely. And that, as a fundamental market analyst and forecaster, Mukesh, you and I have shared a journey of providing a forecast. We need to have one line for our clients to say that this is how it happens. We can't just
Yeah, you cannot
brush
say one
before,
hand, the other
right?
hand. Yeah.
That one line in our
Mm-hmm.
books right now is, as you said, a slow recovery in flows, which is in the form of all these efforts between Iran and Oman, and then discussions among the parties, just creating new ways, while also engineers expand the pipelines. There's UAE is working on that. Saudi are looking at adding more capacity and potentially more pipelines. Kuwaitis are active, talking to people how they can get it out to different outlets that they may reach themselves to out of the Strait of Hormuz. And Iraq has a long list of pipelines that they want to build. So those are what engineers are working in the background, which could potentially slowly increase this. So when I say business as usual and status quo, it doesn't mean flat. It means a slow recovery through democratic pathways, but also engineering solutions.
So you have two steps forward, one step back, and then sometimes go back and forth, and then how you solve the problem. I do want to, so that's a very good macro bias and a macro perspective you have established, Iman. Let's do some details. I know you watch the market in a lot of numbers and probably at FG long years, and I can see a lot of beautiful pictures behind you. There's a lot of history there. Uh, let's talk numbers. Iraq and Kuwait. What's your perspective? Because I believe Iraq and Kuwait together accounted for almost 5 million barrels of crude being exported, and they probably produce 7 million barrels of crude and products. Those are the two players which got, I believe, beaten the most. Iran was able to export a lot of oil. Saudi found an alternative. So, what, in your view, Iraq and Kuwait are doing at the moment to kind of come out of this situation?
Yeah, very good question. Both of them are at the end of the Persian Gulf and significantly dependent on the Gulf, with one exception that Kuwait is entirely landlocked and Iraq has some Iraq is also landlocked, but has some access through Turkey and potentially Jordan and Syria to other waters, which has been helping them in the past and is also during the conflict. But there is also another difference between them. While Iraq has been able to expand their refining capacity over the past few years, slowly, not through a huge refineries such as Al Zour, which is what the case in Kuwait. They have been adding slowly but surely CDUs to different refineries and also expanding and bringing Karbala refinery, expanding Beji and Basra. However, because of their budget problem, they were very keen in maximizing their crude exports. And also, it was much easier for them in terms of logistics to focus on getting crude out of Basra. But then they were constrained by OPEC. OPEC Plus was a big barrier for Iraq to utilize those capacities before the war. Now, when the war happened, they were stuck with little to no crude export capacity. But then they decided that, well, maybe now we start to transform those into fuel oil, which is basically most of the refineries in Iraq are simple hydroskimming refineries, basically fuel oil factories. And why don't we do this? We convert it, we get some middle distillate for internal use, and then the fuel oil, we can export it, which they did. That helped them not to bring their refinery runs as low as some other countries in the region, especially Bahrain, Qatar, and Kuwait had to cut their refinery runs because of their surplus products. Iraq managed to keep their refinery runs a bit less impacted. They haven't been able to also still bring their runs close to capacity, but that helped them. And now they are working on the pipeline with Turkey, which is another long story of where a cooperation could have benefited multiple players, including Iraq, but also Turkey, and lack of and within Iraq, Kurdistan regional government as well as federal, and lack of has proven to be not helpful. Kuwait, however, on the other hand, were a country that managed to expand their refining capacity significantly, but they were hit on both crude and fuel oil. Remember, Al Zour is also a fuel oil factory producing a lot of
very low sulfur is an IMO 2020 factory.
Correct. But it was exporting a lot of those to Fujairah, which is outside the Strait of Hormuz, and also the demand for bunker fuel there has dropped because people would rather to take their bunker elsewhere rather than in a port that has also been exposed to some of the fireworks over the past 5 months. So Kuwaitis has been hit by both crude and products. In terms of runs, Kuwait production in 2025 was about 2.6 or 2.7 million. In July, our assessment is 1.5 million, so just above half half of what they were producing last year. Iraq, however, has been hit more because, again, a lot of their exports, 3.4 million barrels per day of crude exports in 2025, dropped so far. In July, our assessment is less than 1 million barrels per day, and that is through north and south. And with their alignment with Iran in terms of political alignment, they have been proven to be the state that got and received more quotas from Iranian in terms of getting their vessels out and blessing due to political relationship that they have had, and hence they were lucky in that way. But their production dropped significantly and has been mostly impacted. I have to say that Qatar and Bahrain are similarly impacted, but they are smaller players and hence less perhaps discussed among us, the energy market analysts.
Well, I think what a fantastic deep dive. Thank you, Iman. We tried to understand Saudi, UAE, Qatar, Bahrain, Kuwait, Iraq options. I want to turn focus to Iran. And you have an heritage, you probably understand better than anybody else from the outside. We always try to think, and a lot of people get it wrong. I looked at some of the data, and what I found was that before the sanctions in 2017, 16, 18, before the JCPOA, US walked out, Iran was over a year's cumulative was pumping almost 1 billion barrels of oil. Sanctions came, the number dropped to 200 million barrels, and almost all was going to China. And when I look at the loadings data, what I found was that Iran was doing a high loading. China was getting almost the 150 million barrels of arrivals. But when you look at what crossed Hormuz, what crossed Malacca, those numbers were much below, which I think the whole world has talked about the dark kind of trades. In 2025, Iran was not able to pump a lot when the new US administration came, and the numbers for the entire year were less than, I guess, 50 million barrels compared to the previous years. But the 6 months in 2026, this wartime, Iran loaded 100 million barrels of oil, almost 30 to 40 million barrels arrived in China, and I don't know where the 60, 70 million barrels is there. So given this opacity of the market, right, how Iran has managed to do this, anything you can share from your understanding, which might help anybody better build a view on this opacity side of the market?
You very well explained the dynamic of Iranian oil industry over the past 8 to 10 years. It has had its ups and downs. Interestingly, Iran managed to bring their production level, total oil production, which is crude oil, condensate, and NGLs, in excess of 5.2 million barrels per day by the end of 2025. That is a historic high since the revolution 47, 48 years ago. And that was through not only recovery in crude production and exports before the war began, but also through expansion of refining capacity at home and condensate splitting capacity. So 2.6, 2.7 million barrels per day of refining and less than 2 million barrels per day of demand gave them close to 800 kbd of surplus products, and then some 100, 200 kbd of condensate. It gave them another 1 million barrels per day of oil in the form of non-crude exports. So that was the case. Now, fast forward into the war, as you rightly mentioned, they had a significant amount of over perhaps 100 million barrels of oil at sea when the war broke. And basically that's what different estimates of between 100 to 150 million were assessment of people. We were closer to 120, 130 million. And that's what basically the US administration tried to tap into when they first gave a general license to place that into the market, to calm the market. It didn't work because the market wouldn't just go and buy a barrel which is sanctioned and pay potentially an entity which is under sanction, and it didn't work. But they continue to place those barrels into China. Some were left, as you rightly mentioned, probably around 60 million. But then the blockade were lifted through that period of MOU, and Iran flushed another 30, 40 million barrels to beyond the Strait of Hormuz and blockade line. So right now we assess again Iran having over 100 million, probably closer to under 10 million barrels of oil, crude oil at sea, waiting to be placed into China. That will get them through another few months. If you assume 1 million barrels per day, that's 100 days of unloading. And that is what I have been telling our clients, and you might have heard me in some of the interviews saying that Iranian oil business is not a conventional oil business that you market and you sell it, and then there is a nomination day loading, and then it's just a smooth journey and unload. It is very unconventional that they keep loading, and then the vessels start sailing. There are a number of middlemen, Iranians, and then some from within the GCC, and then it gets into Indonesia, and then Malaysia, and then China. Some people basically transfer just the ownership. Some people transfer the cargo. In fact, 1, 2, 3 times ship-to-ship transfer. Even then, it may find itself into Chinese waters and wait there to be unloaded. Some of them even get unloaded in what Iran has secured to be storage tanks in basically non-bonded storage sites in China. Last time I got some intelligence around that, it was more than 30 million, perhaps close to 40 million barrels of capacity Iran had basically under their control in a non-bonded storage outside the Chinese custom that could give them flexibility in bringing the cargoes, unload them, and then sell it to the system. So I believe that was also part of Iranian resilience and part of miscalculation by the U.S. administration, in the sense that blockade could impact others without this very sophisticated conventional sales system more than Iran itself, which are nearly all the neighbors, because they were not prepared for this kind of delay. And remember, we think the Iranian oil export business, instead of a 2 to 3 weeks business that is perhaps for ADNOC or some other entities, Saudi Aramco, Babco, and others, it's more of a delayed 2 to 3 month business. But then they also get paid up to 90 days after. So there is a long payment term that is part of the discount that Iran gives to Chinese. So even from the financial point of view, the money cash flow stopped a lot earlier for the other people within the Gulf than it did for Iran, as they are still receiving the money for what they sold in February before the war began. So from all that point of
fascinating.
View, it did contribute to their resilience in terms of standing longer against this very, very disruptive conflict.
So bottom line, Iman, what you're trying to say is that Iran had probably, because of long years of sanction, kind of prepared itself for disrupted way of operating. The players who were operating in the smooth way never learned how to handle the disruption. Iran was so well prepared, and whether the oil is sitting in a well in Iran or the oil is sitting in a tank in China, it's not available to the market easily. And that's how Iran has maintained its resilience. Wow, fascinating. And I think some of the numbers you talked about. I also want to because you mentioned in your journey NGLs, ethanes, and of course now FG, Nexant, I think petrochemicals is a big focus, right? Any takes because we heard Panama Canal has water problems, and US and China are kind of in some ways joined by the hip in terms of petrochemical feedstocks. China, big petrochemical consumer, feedstock consumer, US producing NGLs and big kind of a producer. And with the Middle East not providing the NGLs, the naphthas, I think this should have brought US and China even more closer. So any quick takes on how one should see the petrochemical market?
Yes, Mukesh, we certainly, for one, benefited a lot from our recent merger with our friends in Nexant with 60 plus years of experience on the petchem market by giving us more insight into what's happening on the other side behind the gateway of the plant, which is where we stopped always looking at the feedstock as demand for oil and NGLs. Now, what we learn is that the petrochemical market was struggling with overcapacity created by China over the past few years. The market were trying to digest this significant amount of capacity that was coming online and is still in the backlog. But then another issue has taken over the petrochemical market, and that's significant reliance of that industry, especially in Asia, to the Middle Eastern feedstocks. 1 million barrels per day of naphtha exports almost entirely to Asia, the equivalent of 1 million barrels per day of LPG also going almost entirely to Asia. That's 2 million barrels per day, more than 2% of the entire oil consumption is now cut out of the petchem market in Asia, and they are stuck with little alternatives, the biggest of which is US. Now that's helping them, especially with US gas supply expanding on the basis of new LNG projects coming online. They're also expanding their shale gas and hence NGLs supply as well as export capacity. That has helped. But remember, the journey of an LPG vessel from Middle East to China is much, much different in terms of time than a journey from US Gulf Coast Houston to China. And that has become now the new problem beyond the normal overcapacity, which was their first problem, then lack of or losing significant amount of feedstock from Middle East. Now securing vessels to both do the new route, US, Asia, but also I'm hearing from some of the traders that when the blockade were lifted, the MOU, no one could easily find a vessel to load an LPG or even naphtha cargo from Iraq or from Abu Dhabi because all the vessels were busy in this multiple long journey. And so the logistics has become the third problem for the petchem market in Asia, which is struggling to find a smooth operation after years. And we don't expect that to happen maybe within a year or two, assuming that first, the logistics issue find a solution. Second, the feedstock, and third, the overcapacity to get digested. We don't expect this to happen anytime before 2028, maybe 2029. So that petchem market, unfortunately, the turbulence has changed the form, but is expected to continue for another year or two.
Okay. I continue always kind of, simplify, Man, by saying we have upstream spares, but we have downstream scares. And we had the downstream scares of refining. Now you add the downstream scares on petchem side. Petchem was at least helping some refiners stay afloat. And now if that is also challenged, probably we might get back the crude production, but people don't put crude in the cars. People put diesel and petrol in the cars, and the entire destruction of the downstream sector, pinch by pinch, inch by inch, the supply chain is going to bite us much longer. I think excellent conversation, Iman. I can continue longer, but before I let you go, tell me a little bit of a story, any of those pictures behind what one or two lessons for the young and emerging analysts you want to leave so that they can't achieve 30 years or 40 years of experience in a few days, but they can really learn from you. And that's my mission with XAnalysts, is to really enable the analyst and bring the experts so that people can learn, they do better analysis, and better analysis leads to better sort of outcomes. So tell us a little bit of a story, and then we'll wrap it up.
Sure. I want to give you two short comments. One on looking forward and the lessons learned from the past 5 months is that I'm bringing it back to the Middle East. The Middle East has not become less important over the past 5 months, or even if you extend it to a bit longer, maybe 1 to 2 years. It has maybe changed its importance from previously known as where the oil barrels or gas comes from to how and who is going to refine them and how to get them to the market. So the market has proven that Middle East is equally important, but maybe some of the importance has shifted from upstream to midstream and logistics. That's lesson number one. Number two, from the journey I have had, I want to refer to a lesson that I took myself from my mentor, Dr. Fisharaki, over his journey of about 50 plus years in the industry. And that is reflected on the wall. Those are all great people. Some of them are oil ministers, some of them are heads of NOCs, some of them are traders, some of them are great analysts like yourself, Mukesh, who have become my friends. But that is the strength of a true market analyst. Looking into numbers is what that can be done by a fresh graduate. Even nowadays, AI could do the same thing. But reading between the lines and making sense of them and understanding that what is a trend, what is a random temporarily blip, all of that comes from having these conversations with people within the industry, and also going to them and having the discussion. Now we're having it for the sake and benefit of public and your audience who listen to this. But we do this kind of talk, you and I and other friends, randomly in industry events, and that's the benefit. That's the key takeaway, that over the years, try to build a network. In the market analysis, the more people you know, the more people you trust to have a conversation with, the better and the stronger analyst you are.
Now, you said it well. It's not just the artificial AI intelligence. You need the network intelligence, and we bounce and we enrich both from, I think I'm walking away learning some of the aspect that Middle East has shown more resilience and cohesion than headlines tell. OPEC has silently played a much bigger part. You very elegantly explained how Iraq and Kuwait and other countries kind of found their strengths and weaknesses and overcome, and how Iran was something I didn't appreciate. Suddenly, something which was a challenge for years become a strength in the war times of managing the market. So that's the kind of perspective I think you have brought and really enriched the people. Of course, forecasting is tough in these volatile times, but I think building perspective should not be tough. And thank you for that. Thank you for such a very fertile conversation. Thank you, Iman. Wish you all the best. And probably I'll see you in Singapore in APEC, and probably in Fujairah in Energy and multiple other forums. And congratulations again, Iman, for your new journey.
Thank you so much, Mukesh, for the invite, and look forward to seeing you soon in all the events that we jointly attend. Thank you.
Thank you.
Analysts. Empowering analysts, transforming markets.